Hello, and welcome back to Boni's Life, the channel where we navigate the chaotic, exhilarating, and often downright baffling world of cryptocurrency. I'm your host, Boni, and today we're doing a deep dive into the digital trenches of the crypto market. Whether you're a seasoned trader with a screen tan that would make a lizard jealous, or you're just dipping your toes in, wondering what all the fuss is about, you've come to the right place. We're going to dissect the current market from every conceivable angle. We'll be looking at the tea leaves of technical analysis, the real-world tremors of fundamental events, and the raw, unfiltered sentiment that drives this beast. We'll cover strategies for the scalpers who live life in 15-minute candles, the swing traders who ride the waves for weeks, and the long-term hodlers who are playing the long game for generational wealth. Think of me as your financial weatherman, here to tell you whether to expect sunshine, a hurricane, or a shower of frogs. Though in crypto, sometimes it's all three at once. So grab your coffee, silence your notifications, unless they're price alerts, of course, and let's get ready to make some sense of this beautiful madness. We've got a lot to cover, from the fear and greed index to the latest moves by the Federal Reserve, and I'll be giving you actionable setups and triggers for your next trades. Let's get to it. Alright, let's start with a bird's eye view. When we look at the entire crypto space, the number that jumps out is the total market capitalization. As of today, we're hovering around a colossal $3.59 trillion. Now, for the uninitiated, that number sounds like something out of a science fiction movie. But what does it actually mean? It's the total value of every single cryptocurrency in existence combined. It's our barometer for the health of the entire ecosystem. Just a day ago, this number was a bit higher, and we've seen a slight dip of about 3.5%. Is this a reason to panic? Absolutely not. In the world of crypto, a 3.5% move is like a gentle breeze. It's the market breathing. What's important is the context. We recently crossed the $4 trillion mark for the first time, a huge psychological milestone. This pullback is a natural, healthy consolidation after a significant run-up. It's the market taking a breather, shaking out some weak hands, and preparing for its next move. Now, let's talk about volume. The total crypto market volume over the last 24 hours is about $142 billion. Think of volume as the heartbeat of the market. It tells us how much money is actively changing hands. High volume during a price increase is a sign of a strong, healthy trend. High volume during a price drop can signal panic selling. Right now, our volume is substantial but not euphoric. It's consistent with a market that is cautiously optimistic but also wary of potential headwinds. We're not seeing the frantic FOMO-driven volume of a market top, nor the anemic ghost town volume of a bear market bottom. This is the volume of a market in contemplation. This brings us to one of my favorite indicators, because it attempts to quantify the most irrational and powerful force in any market. Human emotion? I'm talking about the crypto fear and greed index. Right now, the needle is pointing to 36, which is firmly in the fear zone. Just a month ago, we were sitting comfortably in neutral at 57. This shift is significant. It tells us that the recent dip, coupled with some macroeconomic uncertainty, has spooked the head. The tourists are getting nervous. But as the great Warren Buffett famously said, it's wise to be fearful when others are greedy, and greedy when others are fearful. A reading of 36 isn't extreme gut-wrenching fear, but it's a clear signal that sentiment has cooled. For a contrarian thinker, this is where things get interesting. This is where you start looking for bargains, not running for the exits. So why the fear? It's not just charts and numbers. The crypto market doesn't exist in a vacuum. It's deeply intertwined with the global economic landscape. The big story recently has been the US Federal Reserve. They just cut interest rates by a quarter point, which is usually like pouring gasoline on a fire for risk assets like crypto. Cheaper money means more money looking for a home, and crypto is a very attractive high-growth neighborhood. However, Fed Chair Jerome Powell threw a bit of a wet blanket on the party by signaling that another cut in December is far from a sure thing. The market, which is always trying to price in the future, had to recalibrate its expectations. That uncertainty, combined with a stronger US dollar, has put a damper on things. Adding to the fog of war is the ongoing US government shutdown, which has delayed crucial economic data, including the upcoming jobs report. The Fed is essentially flying with some of its instruments offline. Traders hate uncertainty more than they hate losses. This lack of clarity is causing many to sit on the sidelines, waiting for a clearer signal. These global events are the invisible strings pulling the puppets of the market. Understanding them is just as crucial as reading a chart. They provide the why behind the what. Now that we have the lay of the land, let's get our hands dirty with the charts. This is where the rubber meets the road, where we translate all that data and sentiment into actionable trading plans. But not all traders are built the same. A strategy that's perfect for a long-term investor would be a recipe for disaster for a scalper. So, we're going to break this down for our three main archetypes: the short-term sharpshooter, the mid-term wave rider, and the long-term visionary. All right, my high-frequency friends, this is for you. You live on the 15-minute, 1 hour, and 4-hour charts. Your goal is to get in, snatch a profit, and get out before the market even knows you are there. For you, the recent volatility is a playground, but it's a playground filled with landmines. Let's talk about the bloodbath we saw on November 3rd. Over $463 million in liquidations. A staggering $405 million of that was from long positions. What does this tell us? It tells us that a lot of traders got greedy, piled into leveraged long positions expecting a straight shot to the moon, and got absolutely wrecked. This is a crucial lesson. In a market this sensitive to macroeconomic news, high leverage is like juggling chainsaws. It might look cool, but one wrong move, and it's game over. The market has a taste for leveraged longs right now, so be incredibly cautious with your position sizing. Looking at the 4-hour chart for Bitcoin, we have a very clear, very immediate battlefield. Our key support is the $106,000 level. This is the line in the sand. We've tested it, bounced off it, and the bulls are defending it with everything they've got. If you're a day trader, a bounce from this level, confirmed by a bullish candlestick pattern, and a tick up in the RSI from oversold territory, is a potential long entry. Your target? The immediate resistance zone between $110,000 and $112,000. That's a solid quick trade, but keep your stop loss tight just below that $106,000 support. A break below that, and we could see a quick flush down to the 100,600 area. Your best friends right now are the RSI and MACD. On the 1 hour and 4 hour charts, the RSI has been flirting with oversold conditions, a dip below 30 on the RSI, followed by a bullish divergence, where the price makes a new low but the RSI makes a higher low, is a classic high probability setup for a quick scalp. Pair that with a bullish crossover on the MACD, and you have a strong confirmation. But don't fall in love with your position. The name of the game for you is profit taking. Set your targets, and when they hit, take your money and run. There will always be another trade. Now, for the swing traders, you're not interested in the minute-to-minute noise. You're looking to catch the bigger waves, holding positions for days or even weeks. For you, the daily and weekly charts are your Bible. On the daily chart, the most important feature right now is the price compression. Bitcoin has been trading in a range between roughly $100,000 and $117,000. This is like a coiled spring. The longer the price stays in this range, the more energy it's building and the more explosive the eventual breakout will be. The Bollinger Bands are confirming this. You can see them squeezing together on the daily chart, a classic sign of decreasing volatility and impending expansion. The question is, which way will it break? Your job as a swing trader is to be ready for either scenario. A decisive daily close above $117,000 on high volume is your signal to go long. That would be a major breakout, and your first target would be the recent highs around $125,000, with a longer-term target of the $135,000 to $140,000 zone. Conversely, a daily close below $100,000 would be a very bearish signal and could open the door to a deeper correction, with targets at $94,900 and even lower. For now, we are in a holding pattern, and the key level to watch is the 50-day simple moving average. We are currently testing this critical support level. Holding above the 50-day simple moving average is crucial for the bullish case. A break below it would be a significant sign of weakness. Your strategy here is patience. Don't get chopped up in the middle of the range. Wait for the breakout, set alerts at your key levels, and when they trigger, execute your plan without hesitation. Ethereum is also showing an interesting setup for swing traders. It's forming a potential bull flag pattern right below its key resistance at $4,100 to $4,250. A breakout above this level could be very powerful. The on-chain data shows a strong support zone for Ethereum between $3,649 and $3,686, which could be a good area to consider accumulating if you're bullish long-term. And finally, for the hodlers, the visionaries, the ones who see crypto not just as a trade, but as a fundamental technological and financial revolution. You're not worried about the daily or weekly fluctuations. You're playing a different game entirely. For you, the current market is just noise. Your thesis is based on the long-term adoption of this technology. And on that front, the news remains overwhelmingly positive. We have giants like MicroStrategy, who now hold over 640,000 Bitcoin, constantly hinting at buying more. Every time the price dips, they see it as a discount. This institutional demand provides a powerful floor for the market. Let's talk about seasonality. Historically, November has been Bitcoin's strongest month, with an average gain of over 40% since 2013. Now, past performance is not indicative of future results, and as we've seen, the macroeconomic climate is a bit shaky this year. But it's a powerful tailwind to have at our backs. The median return is a more sober 8.8%. But even that is a significant edge. Your strategy is the simplest, and yet, for many, the hardest to execute: dollar cost averaging. You don't try to time the market. You buy a fixed amount of your chosen assets at regular intervals, regardless of the price. When the price is high, you buy less. When the price is low, you buy more. This strategy smooths out your entry price over time and removes emotion from the equation. The current dip, with the fear and greed index in the fear zone, is a prime opportunity for a DCA investor. You are buying fear, which is exactly what you should be doing. Your time frame is years, not days or weeks. You are accumulating for the next halving, for the next wave of global adoption, for a future where this technology is integrated into the fabric of our financial system. The current price action, the liquidations, the Fed meetings, they are all just blips on a much larger radar. Your job is to zoom out, stick to your plan, and have the conviction to hold through the volatility. Because in the long run, the trend has been and continues to be up and to the right. We've analyzed the market, we've dissected the charts, and we've identified the key levels. Now, let's put it all together into a concrete playbook. How do you actually trade this market successfully? It's not enough to know what's happening. You need a strategy to capitalize on it. And again, the right strategy depends entirely on who you are as a trader. For my scalpers and day traders, your mantra is risk management. The market has shown its willingness to punish over-leveraged positions. So, rule number 1, dial back your leverage. A 3 to 5 times leverage is more than enough to generate significant profits on short-term moves without exposing yourself to catastrophic liquidation risk. Remember, the goal is to stay in the game. You can't win if you're not at the table. Your primary strategy in this environment should be range trading. We have a well-defined range on Bitcoin between $106,000 and $112,000. This is your sandbox. Your plan is simple. Buy at support, sell at resistance. When the price approaches $106,000, you're not panic selling, you're looking for signs of a bounce. You're watching for bullish engulfing candles, hammer patterns, and a rising RSI. When you see that confirmation, you enter a long position with a tight stop loss just below the support level. Your target is the top of the range. As the price approaches $112,000, you're not getting FOMO, you're taking profits, and if you're an aggressive trader, you might even consider a short position with a stop loss just above the resistance targeting the bottom of the range. Another powerful tool in your arsenal is open interest. Open interest represents the total number of open futures contracts. When open interest is high and rising along with price, it confirms a strong trend. But when open interest is high and the price starts to stall or reverse, it's a warning sign. It means a lot of positions are trapped and a cascade of liquidations could be imminent. Use a tool like CoinGlass to monitor open interest in real time. A sudden, sharp drop in open interest can signal the end of a short-term move, and be a good trigger to take profits. Finally, be a news trader. The market is incredibly sensitive to macroeconomic data right now. Keep an eye on the economic calendar. The release of the US jobs report will be a major volatility event. In the minutes leading up to the release, it's often wise to flatten your positions and wait for the dust to settle. The initial move on a news release is often a fake out. Wait for a clear trend to establish itself in the aftermath before you jump in. Don't be the first to the party. Be the one who arrives when the music is good and the direction is clear. For my swing traders, your greatest asset is patience. You are waiting for the big multi-day or multi-week move. Your enemy is the chop, the sideways price action in the middle of the range that can slowly bleed your account dry. Your strategy is to wait for a confirmed breakout from the current consolidation range. Set your alerts at $117,000 on the upside and $100,000 on the downside. Don't just trade the alert. Wait for confirmation. A true breakout is not just a price piercing a level. It's a price closing a full daily candle above or below that level, preferably on higher than average volume. This is your signal. This is the starting gun for the next major wave. If we get a bullish breakout above $117,000, your strategy is to buy the retest. Often, after a breakout, the price will come back down to retest the old resistance level as new support. This is your safest entry. It confirms that the breakout is real and gives you a clear level to set your stop loss against. Your first target is the recent high around $125,000. But don't sell it all there. Take some partial profits, move your stop loss to your entry point, making it a risk-free trade, and let the rest ride. Your ultimate target is the $135,000 to $140,000 area. If we get a bearish breakdown below $100,000, the same logic applies in reverse. You would look to enter a short position on a retest of $100,000 as new resistance. Your targets would be $94,900 and potentially lower. As a swing trader, you should also be paying close attention to the weekly chart. The weekly trend is still bullish. We are making higher highs and higher lows. Until that structure is broken, the path of least resistance is up. This recent dip is, for now, just a pullback in a larger uptrend. Use this perspective to maintain your bullish bias, but always be prepared for the trend to change. The weekly moving averages are your guide. As long as we are trading above the 21-week and 50-week moving averages, the long-term trend remains your friend. And for my long-term investors, your playbook is the most straightforward, but it requires the most emotional fortitude. Your strategy is accumulation. You are not trading, you are investing. You are buying a piece of a technological revolution. Your primary tool is dollar cost averaging. You have a set amount of capital that you deploy at regular intervals, weekly, bi-weekly, or monthly. You buy and you send your crypto to cold storage. You are not concerned with the day-to-day price swings. You are focused on accumulating as much of your chosen assets as possible over a long period. This current market environment, with the fear and greed index in the fear zone, is a gift for a DCA investor. You are getting to buy at a discount. You are buying when others are fearful. This is how you build a strong, low-cost foundation for your portfolio. Your goal is to lower your average entry price over time, so that when the next major bull run kicks into high gear, your profits are maximized. Your research should be focused not on technical analysis, but on fundamental analysis, which projects are building, which have strong developer communities, which are solving real-world problems. These are the projects that will survive and thrive in the long run. Don't chase the latest meme coin. Invest in technology, in innovation, and in the teams that are building the future. And finally, have a long-term perspective. We are still in the early innings of this game. The global adoption of cryptocurrency is just beginning. There will be booms and there will be busts. There will be periods of euphoria and periods of despair. Your ability to zoom out, to see the big picture, and to hold on to your assets through the volatility will be the ultimate determinant of your success. Don't let the short-term noise distract you from the long-term signal. And that's a wrap for today's deep dive. We've covered the good, the bad, and the ugly of the current crypto market. We've looked at the big picture, we've gotten granular with the charts, and we've laid out actionable strategies for every type of trader. The key takeaway is this: the market is in a state of consolidation, a tug of war between bullish fundamentals and bearish macroeconomic sentiment. This is a time for caution, for discipline, and for a clear, well-defined strategy. Whether you're a scalper, a swing trader, or a hodler, there are opportunities to be had, but you must be smart and you must be prepared. Thank you for joining me on Boni's Life. If you found this analysis helpful, do me a favor and hit that like button. Subscribe to the channel and ring that notification bell so you never miss an update. And I want to hear from you. What are your thoughts on the market? What trades are you looking at? Let me know in the comments below. Until next time, trade smart, stay safe, and may the crypto gods be ever in your favor. I'm Boni, and this is Boni's Life.